Everything you thought you knew about the safety of your bank account just changed. While you were sleeping, the Federal Reserve and the FDIC just hit the reset button on the American financial system. We're talking about a massive overhaul that could determine whether you can actually withdraw your money during the next crisis, or if the bank has the legal right to lock the vault and say, "Not today." This isn't just boring paperwork, it's a total transformation of the US dollar as we know it. If you have more than $1,000 in a traditional savings account, you are standing on a fault line that just started to shift. The core of this shift is the Basel III Endgame. For years, banks have been playing a high-stakes game of poker with your deposits. They take your cash, lend it out at a 10-to-1 ratio, and hope nobody asks for it all at once. But after the collapse of Silicon Valley Bank and Signature Bank, the regulators panicked. They realized the liquidity they thought existed was a mirage. Now, new mandates are forcing banks to hold significantly more capital. On paper, this sounds like a win for safety. In reality, it means the end of easy money. When banks have to hoard more cash to satisfy the government, they stop giving out loans to people like you. Mortgages get harder to find, credit card limits shrink, and the cost of borrowing enters a death spiral. We are moving from an era of expansion into an era of extreme financial contraction. Wait, before you think this is just about bank reserves, look at the hidden side of these rules. The regulators are now tracking unrealized losses. This means if a bank buys government bonds and those bonds lose value because interest rates go up, the bank has to admit it immediately. In the past, they could hide these losses under the rug. By exposing these wounds, the government is essentially preparing for a massive consolidation. Small community banks, the ones that actually know your name, are being squeezed out because they can't afford the compliance costs. We are heading toward a future where only 4 or 5 megabanks exist, acting as digital arms of the federal government. Stop scrolling and listen closely. Your bank is no longer a storage locker for your wealth. It has become a gatekeeper for your behavior. With the introduction of these new reporting standards, every transaction over a certain threshold is being scrutinized not just for fraud, but for risk profile. If you think your private bank account is still private, you are living in the past. The walls are closing in and the exit ramps are being guarded. This brings us to the most controversial part of the new framework, the integration of digital assets and the potential FedNow expansion. While the headlines talk about stability, the fine print discusses programmability. The new rules lay the groundwork for a system where the government can monitor the velocity of money in real time. If the economy gets too hot, they don't just raise interest rates anymore. They can theoretically limit how much you can spend in certain categories. They're calling it macroprudential policy, but it looks a lot like a social credit system for your wallet. This is why the big banks are suddenly pivoting toward tokenized deposits. They want to turn your US dollars into digital coupons that they can track, trace, and, if necessary, turn off with a single line of code.
What happens to your emergency fund in this scenario? Under the new liquidity coverage ratios, banks are being incentivized to prioritize government debt over consumer deposits. This means in a liquidity crunch, the bank's first loyalty isn't to the person with a savings account, it's to the federal balance sheet. We are seeing a fundamental shift in the definition of money. It used to be an asset you owned. Now it's becoming a liability the bank owes you, subject to their terms and conditions, which can change without a vote or a notification. If you think the government will just print more money to save the day like they did in 2020, you're missing the trap. The new rules are designed to prevent that specific type of inflation by locking the money inside the banking system. They are creating a walled garden. You can see your balance on the screen, but moving it out into physical cash or hard assets like gold or Bitcoin is becoming a nightmare of red tape. They are building a digital cage, and these new banking regulations are the bars being welded into place right now. The too big to fail era has evolved into the too big to escape era. As these rules take full effect, the distinction between a private bank and the central government is disappearing. We are entering a period of financial repression, where the goal is to keep your money trapped in the system so it can be devalued to pay off the national debt. The interest you earn on your savings will never outpace the real inflation rate again. That is by design. The system isn't broken, it's being redirected to serve the state at the expense of the saver. You need to understand the liquidity trap being set for the average American family. While the media focuses on political theater, the technical changes to Tier 1 capital are what will actually determine your quality of life over the next decade. If you are sitting on cash, you are holding a melting ice cube in a room where the thermostat is controlled by people who want the ice to melt. The shift toward a cashless society isn't a conspiracy. It's the ultimate goal of the new regulatory framework. Why? Because you can't run from a bank that exists only on a server. The final phase of this plan is the stress test upgrade. Every year, the Fed runs simulations to see if banks can survive a crash, but the new tests include climate risk and social risk factors. This means banks can be penalized or forced to close if they lend money to industries that the current administration doesn't like. Whether it's oil, firearms, or even certain types of farming, your bank is being pressured to cut off or debank anyone who doesn't align with the new digital ESG standards. Your money is being weaponized against your own interests. Don't wait for the bank holiday announcement to realize your exit strategy is gone. The window to diversify out of the traditional system is closing faster than anyone is willing to admit on the evening news. The rules have changed, the players have changed, and the game is rigged. You have two choices: stay in the pen and hope the shearers are gentle, or learn how to become your own central bank before the endgame is complete. The choice is yours, but the clock is ticking.